Something just cracked beneath the surface of the currency markets, and precious metals noticed before almost anyone else did. Gold tore through a level it had been struggling with for weeks. Silver flinched at the same barrier and for now refused to cross it. The question every trader, every saver, and every long-term holder wants answered tonight is simple. What actually triggered this move, and is it the beginning of something bigger or just another flare-up in a market that has been anything but calm this year? Let's set the stage properly because context matters more than the headline number. Gold pushed convincingly above its 50-day moving average, a technical line that traders watch as a signal of shifting momentum. Silver approached that same line, bounced off it, and pulled back without a clean breakout. That divergence between the two metals is itself a story worth unpacking. But first we need to understand the macro forces that lit the fuse to make sense of where we are. It helps to rewind to an earlier chapter that many market watchers keep referencing. Back in the spring of a prior year, when a major economy found itself cut off from key parts of the global payments network as a consequence of geopolitical conflict, the rest of the world took notice. Central banks around the globe suddenly had to confront an uncomfortable possibility that the world's dominant reserve currency could, in theory, be weaponized against any nation that fell out of favor with its issuer. That realization sparked a wave of reserve diversification. Nations that had leaned heavily on a single currency for their foreign reserves began quietly building up alternative stores of value, and bullion was the natural beneficiary. That steady, patient accumulation gave the metal a tailwind that lasted for years and eventually turned into something closer to a sprint. By the turn of this year, that sprint had become genuinely parabolic. The rally into the opening weeks of the year was one for the record books, the kind of move that gets talked about for years afterward. Seasoned participants who had ridden the trend for a long stretch began trimming exposure, not because they had turned bearish, but because prudent risk management demands taking some chips off the table after an advance of that magnitude. What followed was a lengthy pause, a sideways grind that tested the patience of even the most convinced longs, with price oscillating stubbornly around a psychologically significant round number for the better part of a month. Why did the advance stall in the first place? The same nations that had been stockpiling bullion for geopolitical reasons found themselves facing new, more immediate pressures. Energy costs spiked sharply due to ongoing regional tensions, and some of those countries likely had to liquidate portions of their reserves simply to pay for imported energy. Others were defending their own currencies as the dollar strengthened on the back of elevated interest rates, which pulled capital flows back toward the United States. Selling bullion to shore up a wobbling local currency is a defensive move, not a bearish signal on the metal itself, but it still weighs on price in the short term. Now let's turn to what actually happened over the past several days, because this is where the story gets genuinely fascinating. It starts with a currency that has become something of a punching bag on global markets. The yen has lost roughly half its value against the dollar over a decade and a half. It used to carry a reputation as a defensive, safe harbor currency during times of stress. That reputation has been quietly retired. Holding it long through recent years has been a painful, unrewarding trade, and traders have largely stopped treating it as a hedge. Faced with a currency in near free fall, the country's central bank stepped in during the closing weeks of summer, deploying tens of billions of dollars to support its own exchange rate. That intervention had a modest stabilizing effect, but on its own it wasn't the headline. The real surprise came when it emerged that officials on this side of the Pacific were coordinating support as well, reportedly buying a comparable sum of the same currency, funded in part by selling euros. That kind of cross-currency intervention doesn't happen casually. It signals genuine concern in Washington about where this was heading. Why would policymakers here care so much about a foreign exchange rate? Follow the chain of logic. Long-term borrowing costs domestically had climbed to levels that made officials distinctly uncomfortable, brushing up against the high 4% range on the benchmark 10-year note. If the currency intervention hadn't happened and pressure had continued building, there was a real risk that the foreign nation in question, which holds an enormous stockpile of domestic government debt, might have been forced to start selling those holdings to defend its own currency at home. A forced seller of that size dumping government paper onto the market would have pushed borrowing costs even higher, precisely the outcome domestic policymakers were desperate to avoid. So what we witnessed was essentially fear made visible, fear from the fiscal authorities that yields were creeping into dangerous territory. And where there is fear of that kind at the Treasury level, it tends to be shared by the central bank as well. The logical next step, if this pressure continues to build, is for the central bank to resume large-scale purchases of government debt to keep a lid on borrowing costs. That is the scenario that has bullion traders genuinely excited because that is historically the environment in which the metal performs best. Many of the buyers piling in over the past few sessions appear to be positioning ahead of exactly that outcome, trying to get ahead of a policy shift before it's officially confirmed. Naturally, nobody in an official capacity wants to use language that sounds like the large-scale bond buying programs of years past. Officials have their own preferred vocabulary for describing purchases of shorter-dated government paper that has been going on quietly for months while their balance sheet expands and the broader money supply grows at an uncomfortably fast pace. Call it whatever label suits the political moment. The mechanics underneath the label don't change, and market participants who have seen this pattern before tend to recognize it regardless of what it's called. It's worth pausing here to properly explain a mechanism that's central to this entire story and that tends to get glossed over in casual conversation, the carry trade tied to that weak Pacific currency. For the better part of 2 decades, interest rates in that economy sat at or near zero, sometimes even below it. That created an extraordinarily attractive opportunity for global investors. Borrow the currency essentially for free, convert it into dollars or other higher yielding currencies, and use the proceeds to buy assets that pay a meaningful return, historically longer dated government bonds, but increasingly in recent years, high-flying growth and technology equities as well. As long as the borrowed currency kept losing value against the dollar, the trade printed money nearly automatically, and for the better part of 15 years, the currency obliged by weakening more or less continuously. The danger in any carry trade is a sudden reversal in the funding currency. If that weak currency strengthens too quickly, the arithmetic of the trade flips, positions get squeezed, and holders rush to unwind, which means selling whatever assets they bought with the borrowed money and buying back the currency to repay the loan. That's precisely the tightrope officials are walking right now. They want the currency strong enough that the foreign holder of enormous quantities of domestic government debt has no urgent reason to sell that debt to defend its own currency, but they don't want it so strong so quickly that it triggers a disorderly unwind of carry positions built up over years, forcing a wave of selling in both government bonds and equities held by those same investors. It's a genuinely delicate balancing act, and there's a reasonable argument that a comfortable trading range for that currency exists somewhere in the mid-150s, with real danger emerging if it strengthens meaningfully below that. There's an additional wrinkle here that doesn't get discussed enough. The money flowing out of that carry trade over the years hasn't only gone into government bonds. A meaningful portion has almost certainly flowed into large cap growth and technology names in domestic equity markets. If the currency strengthens aggressively enough to force a genuine unwind, the ripple effects wouldn't be confined to the bond market. We could see real pressure on the very same technology names that have dominated headlines and index returns for years, alongside whatever happens with government debt that connects directly to another theme worth exploring, one separate from currencies but deeply intertwined with everything else happening right now, the astonishing concentration of the equity market in a small handful of technology names. Earlier this year, the 7 largest companies by market capitalization accounted for roughly 35% of the entire broad domestic index. For perspective, the previous record highs for top 7 concentration set decades apart during 2 very different eras, one dominated by energy and the other by an earlier technology boom, topped out around 26%. We were sitting well above any prior extreme. That figure has come down somewhat since, closer to the low 30s, but it remains historically stretched. Rotation away from that concentration, broadening participation out to a wider swath of the market, is generally viewed as healthy. But extreme concentrations rarely unwind gracefully. They tend to unwind in fits and starts with volatility spikes along the way, particularly when the starting point is this stretched. We've already seen early signs of this playing out, with sharp swings in leading chip manufacturers rippling through the broader technology complex. From there, the rotation has been finding its way into materials tied to data center construction, industrial metals like copper, and increasingly into silver itself. Though there's likely a long runway left before that rotation fully plays out, let's ground all of this in where prices actually sit right now. The precious metal complex remains firmly elevated, with the yellow metal trading in the low 4,200s and its silvery counterpart holding above the $61 mark. Meanwhile, bond yields have been creeping higher again today, adding a handful of basis points, which tells you the tug of war between competing forces is far from settled. Why the sensitivity to what looks on the surface like small movements in yield? Because markets today have very little else to chew on besides incremental data points. so every tick gets scrutinized and traded. Officials suggesting they'll offer less forward guidance going forward has itself become a source of anxiety, even though historically that guidance wasn't always especially reliable anyway. Traders have simply adapted to treating every headline as tradable information, however marginal. Today's uptick in yields traces back largely to energy prices moving higher again. There's a direct transmission mechanism at work. Elevated energy costs feed into borrowing costs because markets recognize that financing an extended period of geopolitical tension is expensive, and expensive conflicts require issuing more government debt to cover the bill. So when energy prices spike, it's often read as a signal that tensions are intensifying rather than resolving, and longer-dated yields respond by climbing in anticipation of heavier debt issuance ahead. It's a genuinely interesting pairing to watch. Energy higher tends to coincide with bullion under modest pressure in the very short term, even while the broader trend for the metal remains constructive. So, was yesterday's historic surge sustainable, or was it a one-off spike destined to fade? The technical picture offers some reassurance, a pullback of only a handful of dollars after a nearly 4% single-day advance. One of the larger moves in recent memory actually belongs in the win column. Had we seen a large chunk of that gain erased today, it would suggest the initial move was an aberration. Instead, price has held remarkably steady, still comfortably above that 50-day moving average. A healthy scenario from here would involve a retest of that average, currently sitting in the low 4,200s, followed by a bounce that confirms the level as support rather than resistance. If that plays out, the next meaningful target sits comfortably higher, though there's also a longer-term moving average overhead, currently in the mid-4,400s. That would need to be reclaimed to fully confirm the bigger trend is back in force. Silver's failure to clear its own 50-day average is worth sitting with rather than dismissing. Historically, the two metals tend to move together, and when one leads for an extended stretch, the other typically catches up, eventually, sometimes explosively. There have been notable exceptions to that pattern, including earlier this year when the silvery metal actually led the charge before the yellow metal followed, a reversal of the usual script that surprised plenty of longtime market watchers. Whether that pattern repeats now, with silver eventually playing catch-up, or whether this turns out to be a move confined mostly to bullion, remains genuinely uncertain. The correlation gap shows up clearly in the numbers from yesterday's session. On a typical strong day for the complex, silver might be expected to move somewhere between 1 and 3 times the percentage move in bullion, given its smaller market and higher volatility. Instead, against a roughly 4% advance in the yellow metal, the silvery counterpart moved a little over 3.5%, a milder response than the historical relationship would suggest. That gap is exactly the kind of detail that makes seasoned traders pause before declaring victory and calling this the definitive start of a new leg higher. One useful lens for thinking about the relationship between the two metals is the ratio between their prices, essentially how many ounces of the silvery metal it takes to buy 1 ounce of the yellow metal. That ratio has swung to genuinely extreme readings in past cycles, at times climbing well above 100, a level that historically signaled the silvery metal was deeply undervalued relative to its counterpart and set up outsized rallies once the gap began closing. A comfortable, historically unremarkable range for that ratio tends to sit somewhere between 60 and 80. Current readings hover in the mid-60s, comfortably within that normal band, which is itself informative. It suggests neither metal is wildly mispriced relative to the other at the moment, even if the near-term momentum between them diverges. Turning to the policy meeting that wrapped up recently, it was an unusually contentious one heading in, with market pricing split close to evenly between two very different outcomes going into the decision. That kind of split ahead of a policy announcement is rare and practically guarantees volatility once the actual decision lands. There's a reasonable argument that policymakers are better served by not signaling their intentions too far in advance of each meeting, because conditions can shift meaningfully in the days leading up to a decision, and an institution that has already all but promised a particular outcome to the market finds itself boxed in ways that reduce its own flexibility. A framework with less advanced signaling, even if it produces more short-term uncertainty around each individual meeting, may ultimately serve the institution's credibility better over time. The vote itself revealed real disagreement beneath the surface, with a meaningful minority favoring a rate increase rather than a cut, a split that speaks to genuinely different read of the current inflation picture among policymakers themselves. That divide points to a deeper debate worth unpacking on its own terms. The difference between inflation driven by a supply shock, in this case energy costs spiking due to geopolitical tension, versus inflation driven by monetary conditions, meaning the sheer scale of money creation and liquidity injected into the financial system over recent years. These two flavors of rising prices behave very differently and historically call for very different policy responses. A supply shock tends to work through the economy in a fairly mechanical way. Energy costs spike. That cost gets passed through to consumers and businesses within roughly 6 to 8 months. And because wages typically don't rise in lockstep with an externally imposed cost shock, it functions almost like a tax, pulling purchasing power out of household budgets. That drag tends to show up as slower growth roughly a year after the initial shock. Central banks historically respond to any spike in measured inflation by tightening policy, raising short-term borrowing costs. Even though there's little historical evidence that higher rates do much to address inflation caused by a supply disruption rather than excess demand, raising rates in that environment doesn't fix the underlying supply problem. At best, it engineers an additional layer of economic slowdown on top of the one the supply shock is already causing. Time to arrive right as the original shock is also biting. Layered on top of that supply-driven story is a separate, arguably more persistent source of upward price pressure. The sheer scale of money supply growth in recent years, measured by broader aggregates that have been sitting at record levels with more liquidity continuously being added to the system. There's a reasonable case that this monetary component of inflation is not transitory in the way a one-time energy shock might be, precisely because it reflects a deliberate, sustained policy choice rather than an external event. One counter-argument worth taking seriously is that productivity gains, increasingly driven by advances in automation and artificial intelligence, may be offsetting a meaningful portion of that monetary pressure, effectively disinflationary forces working against the inflationary ones. If you were able to strip out the energy-driven component entirely and just look at underlying monetary conditions against that productivity offset, the picture might actually look more balanced than headline inflation figures suggest, even though the current run of readings above a familiar 2% benchmark has now stretched past 5 straight years. That raises a provocative question worth sitting with. Should markets simply get comfortable with a higher long-run inflation target, something closer to 3% rather than the traditional benchmark? There's a case to be made that policymakers have effectively already made that choice, whether or not they've said so explicitly. It's worth remembering that in the years leading up to the pandemic era, officials spent the better part of a decade openly frustrated that they couldn't get inflation up to their stated target at all, and they pursued policies explicitly designed to push it higher. That context matters because it means the inflationary period that followed wasn't purely an accident of external shocks. It was at least in part a policy outcome that was openly telegraphed in advance, right up until the point where officials realized they had overshot and needed to walk it back. There's also a structural fiscal dimension to why a higher inflation tolerance might be quietly preferred in some corners of government. Elevated levels of government debt, along with debt loads carried by some of the most heavily indebted regional governments, become considerably easier to service if that debt can effectively be repaid using currency that buys less in the future than it does today. Running inflation modestly hot over an extended period is functionally one of the more painless ways to work down the real burden of an enormous debt load without ever having to make an explicit, politically painful choice to cut spending or raise taxes dramatically. This brings us naturally to how that debt is actually being issued and managed day to day, because the mechanics here matter more than headlines suggest. There's been a noticeable shift toward financing government borrowing needs using shorter dated instruments rather than longer dated bonds, a reflection of the fact that demand for paper at the long end of the curve, where yields on 30-year debt now sit above 5%, has been softening. Currently, a bit over a fifth of all marketable government debt outstanding sits in short-term instruments, modestly above the historical norm of roughly 15 to 20%, though not wildly outside that range yet. Still, leaning more heavily on short-term financing creates its own risks, because it means a larger share of total government debt needs to be rolled over and refinanced continuously, exposing the whole system to whatever borrowing costs happen to prevail at each refinancing date rather than locking in rates for decades at a time. This pattern of leaning on shorter maturities isn't new to this particular administration. It traces back through multiple prior bond auctions at the long end that went poorly well before the current leadership took office. The underlying issue hasn't been resolved by any change in administration, because the spending patterns that created the pressure haven't meaningfully changed either. If anything, spending has continued climbing, offset partly by stronger tax receipts flowing from genuinely improved economic activity tied to recent policy changes. But that kind of activity-driven revenue boost tends to have a limited shelf life rather than solving a structural imbalance permanently. Global appetite for absorbing an ever-growing supply of government paper appears to be cooling at the margin, and that's precisely the dynamic that has kept a steady bid under bullion for a long stretch now. There's a real risk buried in this reliance on short-term financing worth naming directly, rollover risk. Constantly refinancing enormous sums of short-term debt means that any disruption to market functioning, whether from a liquidity squeeze, a geopolitical shock, or simply a moment where buyers step back, can create outsized stress precisely because so much needs to be refinanced on a rolling basis rather than parked safely for years at a time. It's genuinely difficult to assign a precise probability to that risk materializing, but it's the kind of tail risk worth monitoring closely because if buyers at the short end ever pull back meaningfully at the same time, even briefly, the resulting liquidity strain could be significant. If we do reach a point where the benchmark 10-year yield approaches roughly the high 4% range, somewhere near 5%, where new label officials prefer this time around. That is historically the environment where the precious metals complex, along with other real assets like farmland and property, tends to perform best because it represents a direct signal that authorities are once again prioritizing market stability over currency discipline. Stepping back from the immediate story, it's worth touching on where broader positioning stands right now beyond just metals. One trade that's been favored for much of this year involves rotating out of the most crowded large-cap growth names and into smaller, domestically focused companies that stand to benefit more from lower borrowing costs, given how much more reliant that segment of the market tends to be on revolving short-term debt financing. A separate trade favored earlier in the year, being long energy, has largely run its course as a preferred position, even though the original thesis around it wasn't built on anticipating the geopolitical disruption that ultimately materialized. It was originally built around a different set of expectations tied to domestic policy changes around business investment. Looking ahead to the next policy decision, current market pricing sits close to a coin flip between another cut and standing pat. There's a reasonable case that officials hold rates steady here, and if they do move in the other direction, it would likely be modest and possibly reversed again fairly quickly afterward, potentially more a matter of maintaining credibility and independence than a genuine shift in the underlying policy stance. Put it all together and you have a genuinely layered story, a currency crisis on the other side of the Pacific that forced coordinated intervention, a fiscal authority visibly nervous about borrowing costs, a central bank that may soon find itself back in the business of buying its own government's debt, whatever new name gets attached to that activity, a historic concentration in equity markets slowly, unevenly unwinding into a broader rotation that has already touched industrial metals and is increasingly touching the silvery metal as well, and underneath all of it, a genuine, still unresolved debate about whether current inflation is a temporary supply-driven headache or the visible tip of something more structurally embedded in how the money supply itself is being managed. It's also worth addressing a question that inevitably comes up whenever a currency intervention of this size happens. Was it actually worth the cost? Tens of billions of dollars is not a trivial sum to deploy defending an exchange rate, and skeptics are right to ask what was actually purchased with that spending. The honest answer is that the underlying structural issues facing that currency haven't been fixed and likely can't be fixed quickly. Meaningfully higher domestic interest rates and a genuine cleanup of fiscal imbalances would be required to restore lasting strength, and neither of those has happened yet despite years of attempts. What the intervention likely bought was time, a pause of perhaps a month or so heading into the next scheduled policy meeting for that central bank, where a decision on raising rates domestically could finally begin to unwind some of the pressure driving the carry trade in the first place. Whether that pause holds until then, or whether pressure begins before officials there are ready to act, is very much an open question. None of this guarantees a straight line higher for either metal from here. Markets rarely move in straight lines, and a single dramatic session, however historic, doesn't erase the need for confirmation over the days and weeks that follow. But the underlying pressures driving the move, currency instability, fiscal nervousness, historic equity concentration, searching for a release valve, and a structural debate over the true nature of inflation are not the kind of forces that resolve themselves in a single trading session. They tend to play out over months, sometimes years, and that's exactly why so many longtime market participants are treating this breakout as more than just noise. Whatever comes next, keep watching that 50-day line in both metals. Keep an eye on how the currency situation across the Pacific evolves in the weeks ahead, and pay close attention to whether borrowing costs at the long end keep climbing or finally start to roll over. Those three threads, more than any single headline, will likely tell us whether this was the start of the next major leg for the metals complex or simply a dramatic chapter within an already long and volatile year. Thanks for spending this time working through it together, and we'll be back soon with the next update as this story continues to unfold.